Hello, my name is Andrew Abraham, and this is my website called Trend Following Mentor. I've been trading for 18 years, now going on 19 years, trend following, as well as I teach, and I also have an upcoming book called The Bible of Trend Following. In this little discussion, I want to talk about John Henry. And John Henry was one of you could say, the grandfather of trend following. He started in the 80s. He did a deal with a major brokerage firm that what he suggested to them was put 5% of your net worth into managed futures. And he had a fantastic, fantastic run trading people's money over the years. But what happened, interestingly enough, he closed his shop. And basically, as I was saying, he was closing his shop. And that has led many to believe that trend following is over. Well, let me tell you a little bit about trend following, my personal experience going back to 1994. It is not easy. There are always going to be hard periods. There are always going to be periods that are extended. And you don't have to have every trade work. Most trades don't work. But that's let's say, the reality. The other reality is it is possible to compound money to mind-boggling amounts of money. And that's what I'm going to show you. First of all, I'm going to show you the record of John Henry. Here's his returns. And he was at about $2.5 billion at his peak. And right now, he's at 91 million. He's closing at the end of December. But what's interesting is he made 90% in 2008. But what also is interesting is here, this drawdown here is just immense. Down 12%, down 21%. That's really hard to accept. So what is the point when you trend follow? The key is not really, in my opinion, again, and I have 3 programs that I trade, that I manage money with, that it's all based on risk. This is high risk, what he was doing. Extreme, swinging for the fences. And John Henry, he owns the Marlins and the Red Sox, so I mean, he's attuned to baseball. I mean, he would really try to hit the ball out of the park, which he did here, 90%, but then he had 24% down and 12 and minus 21. It's not easy. The converse of him, or I don't want to say the converse, I'll just I'll share with you another story. It's called Hawksbill. And Hawksbill, he actually was one of the original turtles. And again, it's not easy with him either. He's had a 61% drawdown. He's managing about $111 million here. It's been going since 1988. Compounded annual rate of return is interesting, 20.86%. In 2008, he did 96%. And you can see he's keeping his drawdowns somewhat less, but they're still tough. And for full disclosure, I've invested with him. What's interesting with Hawksbill, one of his first investors invested with him $300,000 in 1988. And he also invested with Eckhart. He also invested with Saxon. And let me show you that piece also. 1 second. Let me just get that up. Hold on 1 second. It was a piece written in Marhedge, and it was January of 2004. And they're talking about Hawksbill. Learning from the mistakes of the past. Interesting piece. And for all of you, if you want, you can email me, and then I'll email you this article and send it to you. But what's really fascinating here, learning from the mistakes in the past. Mistakes in the past is taking on too much leverage, is trading too much risk per trade or too much risk. And the fact is, it's really tough because as I showed you, had 61% drawdowns. And that's really hard to live through. And most people quit. But what's interesting, he has a manager, he has an investor, and it says it right here. An example of a mutual benefit between long-term relationships between the clients and the firm. Shanks cites the first client of his global diversified program who invested $300,000 in 1988. Redemptions of $1 million. This client's account grew to $18 million in 2003 or 2004 when this was written. And it's back here. It's 2000 and 2004. What's the interesting thing? This same investor compounded money with his investment in Hawksbill, $300,000. He took out $1 million, And today it's worth about $30 million. This is the reality, but don't negate that this is easy. He went through long periods. He didn't make money. Big drawdowns. I mean, look at all these drawdowns. Down 25%. How many people would feel comfortable being down 25%? Or another year down 27%? It's not easy. Here, look at how big this drawdown is. I mean, you got almost 4, 13. You're down 27% here within a couple of months. It's not a warm feeling. And when you invest in a CTA or a trend follower, this is money that you should never really, need. This is risk money. And also, the most important issue is past performance. All his prior returns here, it's not indicative of future performance. Past performance is not necessarily indicative of future results. The way I take the idea of with John Henry and John Henry closing, and even these drawdowns here, these ugly drawdowns, personally, I'd be using them as an opportunity to invest. I buy drawdowns of managers or programs that are having hard times. I don't believe that trend following will end. Again, that's my personal opinion. But again, past performance is not necessarily indicative of future performance. But I'm willing to risk my money to see what happens. And again, it's an idea to share with you with John Henry. I mean, he blew up, or could be said to blow up, or just wasn't interested anymore because he made all his money. I mean, when he was managing his $2.5 billion, and he started becoming interested in baseball. Maybe he lost the passion. I can't answer for him. But what I do believe is there's cycles. There's always going to be ugly drawdowns that are going to challenge us and make us think and quit. And quitting is easy. But the real thing is if you can stay in the game and stay in this marathon of trading, possibly, potentially, good things can happen. I mean, imagine you look at these numbers here. -8, 1, 6. And what most people say is, well, how'd you do last month? That's not the issue. The issue is understanding the program and how the program works and how the risk measurements are in place. Because again, you are going to go through ugly periods like this. But then, you know what? You stumble sometimes into periods like this. This is what trend following is. It's not dead, but it's definitely not easy. And it's definitely not for everyone. And the other reality is, and I can't highlight it enough, is past performance is not necessarily indicative of future results. Again, you make your mind up. You figure out your idea. I've made mine. I think now, with the implosion of John Henry and the drawdowns of so many managers, and I can go manager by manager by manager, myself included, that there's going to be periods of some good turnarounds, some good runs. There has to be. This is what trading is about. And this is what trend following is about. And if I can help you in any way, please let me know. And if you'd like a copy of this article, I'll email it to you. It's Andrew. Here you can see it. It's easier this way. Oops. Andrew at trendfollowingmentor.com. And trend following can be used for stocks, commodities. It can be on any time frame. And again, I invite you to pick up my book, The Bible of Trend Following. Thank you very much.